for about the last decade and a half, interest rates have been exceedingly low. And there was a period where a lot of politicians and economists even were saying, well, look, interest rates are so low, we can just borrow all we need, and it's not going to be a big deal. But we've now seen in the last 18 months or so, with inflation rising and interest rates rising, it looks like this, is the old saying, the chickens may be coming home to roost. What's sort of your perception on this trade-off between interest rates are low, we can borrow, no, don't worry, but now it looks like interest rates are rising. Have we set ourselves up for a big problem here?
Well, Steve, I'm in total agreement with you that the assumption during the it's a combination. Again, we had a major crisis, and that in COVID, and it's not to suggest that government shouldn't have been intervening to provide a safety net. Maybe we overdid it in terms of the amount of assistance was provided. But the assumption was that, or one of the reasons that we could do this, and I think it was the new monetary theory or whatever that claimed that, listen, low interest rates, we should be able to spend whatever we want to. That's not a problem. And when the inflation comes, we will correct for that with increasing taxes and something. Of course, then that's back to the legislative branch, not our friend Jay Powell having to control it. So that's strange. But to put this in numbers, this morning I just glanced at the 10-year T-bill rate that I look at as a major factor in determining our interest payments, is about hitting about 4%, 3.9 this morning. I went back, Steve and Tori and Bob, and the little interactive model that I use a lot, I plugged that into the current projections going out. And if I just take where we are today, at 3.9%, over the next decade, that will add another $3 trillion to the baseline in terms of debt that we're accumulating. So we've got ourselves in a mess from my perspective by having assumed that we could have all this spending. It's not going to cost at very low interest rates. I don't think we're going to see those low interest rates. In fact, if Jay Powell is successful, we're going to continue to see those interest rates probably even go above the 3.9% that I'm seeing this morning. And that rate of increase, then, as I think Tori mentioned earlier, that's interest payment that has to be made. And that, if you're worried about the debt and deficit, that means you need to be focusing on some of those investment programs, first of all, or national security, where we will be spending more just to pay the interest on the public debt than we are paying to secure our national security. And I have one other issue that, again, I'm not very good at this in terms of thinking it all the way through, but I'm very concerned about the fact that, by the way, this creates a very strong dollar, obviously, as we're seeing, but the impact this has internationally and globally. As our old friend Rudy Pinner liked to say, we're the best looking horse in the glue factory. We attract foreign investment. And as I think about 40% of our debt today is that which is, thank you very much, foreign investors. If this becomes questionable as to whether or not we're going to be able to service our debt, which I pray to God never comes to pass, but if that ever becomes an issue, then we're going to start to lose the investments here from our foreign investors, which will then be the price of money, would further drive up interest rates, because we'll try to attract more investment by increasing interest rates even more. So I think there's some real dangerous shoals out there coming, unless we start to focus more on this issue of the level of debt we have.